Good morning and welcome to another Five with Fitz. I'm, of course, Keith Fitz-Gerald. Thank you, as always, for joining me. I had no idea that doing these videos in addition to the written version of Five with Fitz was going to be so much fun, let alone that all of you would find this valuable. So thank you for your kind words. Thank you for paying attention. And most of all, thanks for spending a few minutes of your valuable time with me today. This is great. Anyway, speaking of great, let's talk about the markets for a minute. The stock market is in the red. All three of the big indices, the Dow, the NASDAQ, and the S&P are in the red as I record this now that the government's reopened. Good. Now, I say that because opportunity rarely knocks twice. Investing is very much a situation of take the risk or lose the chance. And remember, no matter what happens, no matter how you feel, no matter how uncertain it might seem, missing opportunity is always more expensive than trying to avoid risks you can't control. We stand on the cusp of the sixth wave, and AI is influencing, transforming really humanity in ways that we couldn't have imagined even a few years ago. So take a look at the chart that I have in the written version of the Five with Fitz today. It is super important. You can get to it through the archives on my website if you want. But we stand on the cusp of something that is fundamentally going to change the course of human history. And that is a monster investable opportunity, even if the markets are in a foul mood today. Here's my playbook. Number one, and perhaps most importantly, the shutdown's over, so why is there no rally, really? Well, U.S. President Donald Trump has signed the bill to reopen the federal government after a 43-day shutdown, the longest in U.S. history. Now, many folks were expecting a rally, but that's not happening yet. Now, why? That's the question of the day, right? Well, that's actually really the interesting part. There's always a reason. And the reason is very simple. There's still too much risk in the system, meaning that the go fast traders are more concerned with what could go wrong than all that could go right. And that flips the switch from buy the dip to sell the rip every time. What you want to do as an investor is stay focused. Patience pays when fear is high. And by the way, there are still some heavy hitters on deck, including NVIDIA, CrowdStrike, Oracle, Broadcom, a number of other great companies, any one of which could light a fire under things and reignite the upside. Now, Keith's investing tip in this department is very simple. The markets are the only store on earth where people fear a sale. Every day without a rally means something's on sale. So think about it that way, right? And by the way, and in case you missed it, I spoke about that, how to invest in a market that scares you or makes you uncertain, with my friend and colleague Scott the Cow Guy Shellady earlier this week. You can watch that video elsewhere on my channel too. One of these days I'll figure out links and timestamps and all that stuff. But, I get the markets, but technology, guys, got a lot of work to do. Anyway, number two today, excuse me, Joby's new hybrid bird flew faster than Congress can approve a budget. Now, Joby Aviation has completed the first test flight of its new hybrid military aircraft just 3 months, 90 days after teaming up with defense contractor L3 Harris. Now, I personally have mixed feelings about this stuff. War, terrorism, and ugliness remain growth industries, unfortunately. Washington is, as many governments around the world, pouring billions into autonomous systems, AI-enabled aircraft, and next-gen mobility because the battlefield is changing faster than traditional contractors can keep up. Now, conflicts in Ukraine and the Middle East have repeatedly shown that winners are the ones who can iterate, adapt, and deploy quickly. Now, that is the real story here, and one that most investors continue to miss. Doesn't matter whether it's Joby, Archer, or Aurora, or names we haven't even heard of yet. The unconventional defense contractors that can deliver dual-use technology, military first, commercial next, are going to have an enormous advantage when autonomy goes mainstream. And that's going to happen very quickly. It's all converging even as I speak. Now, one of my faves in this department has returned 203.64% over the past 5 years, more than double the still fabulous 91.76% from the S&P 500. Now, I bring this up because I want to make sure you've got this covered in your own investing, or at least thinking along similar lines. If you'd like some help, you know where to find me, of course. Number 3 today, the Magic Kingdom still has a TV problem. Oh boy, this is too bad, right? Because we're talking about one of the proudest brands on earth, or at least it used to be anyway. But Disney reported earnings, and the headline numbers look fine at first glance. Streaming profits were up 39%. Disney Plus added 3.8 million new subs, bringing the total to 131.6 million. Hulu is at 64.1 million. Experiences, meaning parks, resorts, cruises, Revenue was up 6%, operating income up 13%, EPS of 111 versus 105 expected, and net income actually doubled from last year. So what's next? Well, Wall Street yawned and hit the sell button. Disney shares are getting smacked today because once again, the good news is getting steamrolled by the same old cable / linear TV in a theatrical slate that couldn't fight its way out of a paper bag. Linear profits fell 21%. Advertising slipped, including a $40 million political ad shortfall. ESPN was flat, and the entire entertainment division saw revenue fall 6%. Oh, and Disney, by the way, is still fighting YouTube TV in a carriage dispute that looks like it's 2009 for crying out loud. Streaming is improving, right? Parks are packed and cruises are selling out. But none of it matters because the TV business is still rotting from the inside out. Now, this is the problem with the house of mouse. The floorboards are giving way faster than management can hammer down new ones. So, yeah, management is doing things. A 50% dividend hike, double the buybacks, and ESPN app bundles, all out the wazoo, all lovingly wrapped in corporate optimism. But the deeper issue in my mind remains unchanged. Theme parks cost a fortune. Brand loyalty isn't what it used to be, and the content pipeline is running on fumes. So, could Disney turn it around? I mean, yeah, sure, anything is technically possible, but should you bet on it? Well, I'm not. You can if you want, but I'm not. In fact, I've repeatedly told you to avoid Disney and buy Putskis, a bet that the stock declines. And if you've done that, it's probably paying off pretty well, so I'm happy for you. I'd urge you to keep Disney on a really short leash if you do own the dang stock, or play it by pairing it against Netflix, for example, meaning that you're simultaneously short Disney, but you're long Netflix, meaning you own it because you expect it to go up. As that gap widens, it's profit in your favor, and that trade continues to work out nicely. Keith's investing tip in this department is very straightforward. Investing isn't just about hot stocks. Sometimes what you don't buy, like Disney, is every bit as important as what you do. Just saying. And again, if you're tired of fighting for Wall Street's table scraps and you'd appreciate some help in this department, OBAers tell me they're thrilled with the one bar ahead model portfolio. If you're a ticker tourist or a quick buck artist, probably not. It's not for you. So I'm just saying and putting it out there. Number 4, I want to talk about Michael Burry again. Looks like he can't stand the heat in the kitchen. Now, this strikes me this morning as, well, what do you know? Michael Burry has deregistered Cyan Asset Management, meaning that the fund no longer has to file 13Fs or disclose positions. Now, why would he do this and why now? Officially, the story is that Burry is moving on to much better things, a comment he noted via X yesterday as reported by CNBC. Yeah, to call me skeptical could just be the understatement of the year, folks. I think there's A, more to the story, and B, it is entirely likely that he simply doesn't want the legal scrutiny that could be building given his latest shenanigans. Now, a lot of people see the guy who called the top, so he gets lots of headlines and headline play. But I see a man walking away from the field much the same way a child picks up his or her toys in the sandbox when the adult says it's time to go home. So anyway, not everything is what it seems. And it's important you understand that as an investor. And number 5, this dumbfounds me, but here we go again. Great. Now you can get surge price in the mountains. Uber has just rolled out Uber Ski, new airport carpooling, and its send-a-ride voucher tool. All right, great, say some. My POV is less than enthusiastic. This strikes me as more like a company rummaging through the junk door, hoping something in there still works. I mean, really? Selling Epic Passes in-app, airport share rides because terminals are jammed? Celebrity videos slapped onto vouchers? I mean, that's not strategy, folks. That's more like duct tape with a surge price in the mountains. Now, Uber's been promising the next big thing for almost a decade. Freight, AVs, grocery, micromobility, memberships, travel. I mean, blah, 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 blah. The company has more abandoned hobbies than a midlife crisis. And irony here is amazing. People bag on Musk for changing his mind? I mean, really? Anyway, revenue growth, no matter how you cut it, still circles back to the same low margin grind, hauling humans from A to B. And food. And I note any determined 12-year-old with a bike and a basket can compete in the food department, by the way. Now, Uber can keep launching features until the cows come home as far as I'm concerned. The only thing that matters to you and me as investors is whether any of them actually change the math. And so far, no, the meter isn't moving. Now, pardon the pun, but my bride and I weren't either recently, moving, that is. Literally, two separate Uber drivers abandoned us at the Orlando airport recently, even though they'd already committed to the drive. The third decided to book the trip, say he was coming, and then evidently take a 45-minute siesta before going radio silent. We've changed to Lyft. I don't know about you, but we've gone to Lyft permanently. I don't want to deal with Uber ever again. Keith's investing tip: when a company keeps reinventing the wrapping instead of looking at the product, go elsewhere. Winners innovate when it counts and where it counts in the margins. Now, trade idea, short, avoid, or put skis, there are bigger, more profitable fish to fry, especially when it comes to companies that are actually building the future. But that's just me. Today's bottom line: buying great stocks on sale never goes out of style, even if you're not getting a rock bottom price and even if there's more selling to come. As always, let's make it a great day. You got this. Thanks for watching, and I'll see you tomorrow. Cheers.